Welcome to the deep dive. Today, we're tackling a really interesting puzzle, actually. It's about HIMS and HERS Health ticker, HIMS, and their latest earnings report for Q2 2025.
Yeah, it's definitely got people talking.
Right. So here's the core paradox we want to unravel for you today. How does the company post such, well, fantastic growth numbers, revenue up 73%, profits more than tripling that, and yet its stock tanks after hours? Big drop. It just doesn't immediately add up.
Exactly. And that's why you really need to dig deeper than the headlines. They give you part of the story, sure, but not the whole picture of the company's health or, crucially, how the market sees it.
So let's peel back those layers. We'll start with the good stuff, the really impressive highlights from Q2, which ended June 30th. I mean, the top line numbers are genuinely strong. Revenue was $544.8 million. That's a 73% jump year over year.
73%. That's massive growth.
It really is. And their profit, net income using GAAP, that hit $42.5 million.
Yeah.
Compare that to $13.3 million last year. So clear profit growth.
Definitely. And adjusted EBITDA.
Right. Adjusted EBITDA, which gives you that cleaner look at core operating profit, came in at $82.2 million. That's about a 15% margin.
And more than double last year's figure. That points to some serious operating leverage kicking in. They're scaling efficiently.
Exactly. And digging into how they're growing, subscribers are up too. 2.439 million now, which is a 31% increase from last year.
Solid subscriber growth.
And what's maybe even more impressive, the monthly online revenue per subscriber, the ARPU, hit $74. That's up 30%.
Okay, so they're getting more subscribers and making more money from each one. That's a powerful combination.
It absolutely is. You look at those numbers in isolation and you think, wow, this company's firing on all cylinders.
Yeah, these figures definitely paint a picture of really robust growth, strong execution, better efficiency. That rising EBITDA margin is key.
So, okay, let's unpack this then. Given all that good news, why the hesitation? Why did the market react negatively?
This is where we look beyond the headlines.
Right. Because the cash flow numbers for Q2, well, they tell a bit of a different story. Operating cash flow was actually negative, minus $19.1 million.
Okay, so cash from the core business activities was negative.
Yeah. And free cash flow, that's after paying for operations and capital spending, that was even more negative, minus $69.4 million.
Oof. Negative free cash flow always gets attention. But there's context here, right? Our sources mention why.
Exactly. It seems a lot of that outflow was down to temporary working capital stuff and, importantly, capital expenditure on automation.
Okay. So investments, things like building inventory or spending on equipment to make things more efficient later.
Precisely. Investments for future growth. But, it's still cash going out the door right now.
And the market often focuses on the right now, doesn't it? That tension between investing for the long term and showing immediate cash generation.
Definitely. And then there's the first, let's call it bad point, maybe. That revenue figure, $544.8 million, as good as it was.
It missed expectations.
Slightly. Analysts were looking for something closer to $551 or $552 million. Not a huge miss, but a miss nonetheless.
And with high-growth stocks like HIMS, even a small miss can trigger a pretty big reaction. The market prices imperfections sometimes.
It seems like it. Psychology, algorithms, it all plays a part when expectations aren't quite met. Okay, so that was Q2. What about the outlook, the guidance they gave?
Right, the forward look. What did they say about Q3 and the full year?
For Q3, they're projecting revenue between $570 and $590 million.
Yeah.
And adjusted EBITDA of $60 to $70 million. That's what, an 11-12% margin?
Okay, so sequential growth expected, but maybe a slight dip in the margin forecast for Q3 compared to Q2's actual.
Seems like it. And for the full year 2025, they actually reaffirmed their previous guidance.
Reaffirmed, so no change there.
No change. Revenue still expected between $2.3 and $2.4 billion. And adjusted EBITDA between $295 and $335 million, which is roughly a 13-14% margin for the year. And here's where it gets really interesting. Because despite reaffirming the full-year outlook, the market reaction was, as we said, strongly negative.
Yeah, that's the crux of it. Why the drop? This brings us to the, let's say, the ugly side of the reaction.
What drove that 12% after-hours fall?
Well, it seems like a combination of factors. First, that revenue miss, even though small, created nervousness about their execution.
Right.
Second, the guidance. While reaffirming the full year sounds neutral, maybe even positive, The market likely saw it as flat, no raised expectations.
So no extra upside signaled.
Exactly. The market always wants more, especially from growth stories. And the Q3 guidance itself, with that slightly lower margin implied, probably didn't boost confidence either. And it felt uninspiring, perhaps.
Okay, so the numbers themselves weren't quite enough to offset the slight miss and the lack of acceleration in the guidance.
Pretty much. It highlights how expectations management is just as important as the actual results for stocks like these.
And were there other factors? External things. You mentioned strategic uncertainty earlier.
Yes, that's the other key piece here. There's some strategic stuff going on. Specifically, the recent news about them ending their partnership with Novo Nordisk.
Ah, right. That partnership termination. That sounds significant.
It is, especially when you consider the context. There's been a lot more regulatory focus, even scrutiny, on compounded GLP-1 drugs recently.
Those are the popular weight loss and diabetes drugs, right?
Exactly. And HIMS and HERS has been involved in offering compounded versions, so ending the Novo partnership combined with that regulatory overhang, it adds a layer of strategic uncertainty.
Potential risks, maybe reputational issues, or just questions about that part of their growth strategy going forward.
Precisely. It adds to the nervousness.
Okay, let's try and bring this all together then. What's the bottom line for you, the listener, trying to make sense of this?
Well, look, the sources are clear. HIMS and HERS put up a genuine, solid growth quarter. Subscribers up, profits expanding nicely. Fundamentally, there's strength there. But the market reacted negatively. And that reaction seems driven by that slight revenue miss, hitting high expectations, the negative cash flow figures, even if they are due to investments. Plus, that Q3 guidance just didn't excite investors looking for more upside. And then you layer on the strategic questions around the Novo Nordisk split and GLP-1s.
So it's a mix of performance versus expectation, short-term cash concerns, and future strategy questions.
Exactly. So while you can be optimistic about the core business growth long term, you also have to acknowledge that these specific issues have raised the short-term volatility risk. Investors are weighing that immediate picture against the longer potential.
It really is fascinating. This deep dive just underscores that impressive growth figures alone aren't always enough, are they?
Not always.
The details matter. Cash flow, guidance, nuances, partnerships, regulatory wins. They all feed into the market's perception. It's not just history, it's the forecast and the potential bumps in the road.
Absolutely. And maybe here's a final thought for you to consider. This situation really shows how sensitive markets can be to perceived risk. Even tiny misses when expectations are sky high or strategic clouds on the horizon. It happens even when a company is growing incredibly fast. So it makes you ask, what truly builds sustainable investor confidence beyond just rapid growth? Is it consistency, predictability, crystal clear strategy, or just constantly beating expectations? It's likely a complex mix, and you see it play out in moments just like this one.